morning, everyone. My name is Cambria Allen-Ratzlaff. I am Corporate Governance Director for the $61 billion UAW Retiree Medical Benefits Trust. The trust is the largest non-governmental payer for retiree healthcare in the United States. My background before then, I came to the trust from the Connecticut State Treasurer's Office, where I worked under Treasurer Denise L. Napier on corporate governance issues. Prior to that, I was with the Council of Institutional Investors as an analyst, and I also serve as an officer on CII's board currently. So I'm going to begin this session by introducing my colleagues. To my left, Erik Bradbury. Erik is a partner at EY's Financial Accounting Advisory Services practice with over 15 years of experience serving some of EY's largest global 360 clients. Previously, Erik served as a fellow at Financial Executives International, where he worked closely with a network of controllers from the largest and most respected companies in the Fortune 500. And then to Erik's left, we have Dr. Anthony Hesketh. Anthony is is an associate professor in the management school at Lancaster University, a visiting professor at Copenhagen Business School, an advisor to EY, and named by HR Magazine as one of the profession's top 10 thinkers. His research broadly focuses on value, with a specific focus on capturing the financial impact of leadership, strategy, and human capital on organizational performance. And his recent work focuses on establishing new ways of understanding and calculating evolving forms of value in modern capitalism. So today, as the title suggests, we're going to be talking about human capital management. And all of us have been working quite a bit on human capital management from various perspectives. We have the investor perspective, the academic perspective, the auditor consultant perspective. But I think the key area here, or the key issue here, is that human capital management has become increasingly important in the U.S. market and certainly among the investor community. So we're going to talk a bit about what's going on, what can you expect coming down the road. And Erik and Ant will both talk about their work with the Embankment Project for Inclusive Capitalism. Some really fascinating stuff. So in addition to my day job, I am chair of the Human Capital Management Coalition. The coalition is a group of 26 large institutional investors, a global group representing over $3.4 trillion in assets that came together around 2013 out of concern that human capital management really hadn't been given the attention it really deserved from the investor community. There'd been a lot of work going on human capital management before then, but the investor voice was, really the one that was missing. I should also point out that CalPERS was a founding member of the HCMC in 2013, and CalSTRS has been a huge asset to the group since 2016. As investors, we view human capital as a key production input and an asset that really should be invested and maximized versus a cost to be minimized. And our concern was that it was viewed more as the latter than the former. And also, part of that is because we really didn't have that much information as investors. If you're not asking for it, you're not getting it. And human capital had become a bit of a black box. So our goal was kind of to change that. So in our first phase of work, we engaged a group of retail companies. We chose those companies because there are a large number of frontline customer-facing employees. And I think there was sort of a view that, they're almost like, interchangeable. And we really didn't think that was right. In our conversations, we realized, we talked to about 7 companies. There's a pretty big range in how companies were viewing human capital management. The first company we talked to was Costco, which has a huge reputation for being just absolutely great at creating value for investors while also developing their talent. And I think there were a few key things that they were doing. First of all, human capital their people were first and foremost. And even though everyone says that people are their greatest asset, they were really putting a push behind this. That was part of their DNA. Employees had a lot more agency than I think they typically do in a lot of other retail companies. There was a lot of communication. It was part of the culture of the organization. Some of the other companies we talked to wasn't necessarily that they weren't thinking about human capital, but since investors hadn't asked about it, we got, kind of, I'd say, response from, what are you talking about? Why are you asking us? We really hadn't viewed it this way. Don't worry, if we're raising wages, we're saving money for you, or we can afford it, versus thinking about human capital as really a way to drive value of the firm. So after that, we realized, as I mentioned, it was a bit of a black box. So investors hadn't been asking for this information. I think maybe it's time that we do. So in 2016, we started preparing a petition for rulemaking to the U.S. Securities and Exchange Commission, which we filed in July 2017. And the petition asked the SEC to start rulemaking on developing metrics on human capital. Prior to then and currently, really the only information that we have that's compulsory from U.S. Public firms is the number of employees. That doesn't really tell us much about how well companies are managing this resource. So we were, our goal was to really make a strong investor argument. One thing I should state, we don't view this as a kind of an ESG issue. It's a fundamental issue to the firm. We're talking about, a key input. So we argued, listen, we can't evaluate company's business, their risks, their prospects without this information. With this information, we can make better capital allocation decisions, better direct capital to its highest value use that is efficient for both us and for the market. Efficiency for us as well in collecting information. Currently, if you're looking for human capital related information, if it's available, you might be looking at a CSR report, you might be looking through websites. Sometimes, if you're Intel, they report their turnover in their 10K now, that's great. But it's usually kind of you're doing a treasure hunt, and that's not great for us either. So standardization also does help with data collection. And it also provides clear expectations to companies as to what information we're looking for. Every single engagement we have, what do you guys want? We pretty much know what we want, but if they're hearing from us asking for X, and another group is saying Y, and then this framework wants this, it's really not efficient. We offered 9 broad categories of information ranging from workforce composition to diversity and inclusion to training and development to human rights. And these categories were intentionally broad because our goal ultimately when we put out this petition was to spark a conversation, was to say, hey, investors care, let's work this issue out. Since then, I think there's been a lot of increasingly vocal efforts from not just the investor community, but Epic has been working on this for quite a while as well. In this area, you have BlackRock prioritizing this as an engagement priority. You have State Street prioritizing this issue. So really, investors are looking at this. Asset managers are looking at this. SASB has also announced that it is prioritizing human capital management in their next round of standard development. And so brings us to this year. In March, the Investor Advisory Committee of the Securities and Exchange Commission voted to recommend to the commission that it take us up on the petition, that it embark on a more formal dialogue, might lead to rulemaking, but really just having that conversation in a more kind of organized, larger way. There was also legislation in May from the U.S. Financial Services Committee that took the 9 categories from the petition and kind of put them into legislations, saying, hey, okay, we need to have this dialogue. One thing I should mention before I turn it over to Erik, from the IAC, Chairman Jay Clayton has made several statements to companies saying, you need to up your disclosure on human capital. And at the IAC hearing, he said specifically that the constituencies he wants to hear from are the boards, but also the allocators. So it's very important that this community and board members really do get involved in this dialogue. So that's my spiel. And I will now turn it over to Erik, who's going to talk about Epic's amazing work. And,
yeah, thank you.
Take it away.
It's actually really helpful to hear your story and kind of the process you went through. I will say, as part of my background, what you didn't mention, which I'll confess to the group here, is that I'm a human capital convert, and that's I wear that badge proudly. I had just come, as you mentioned, from working with as a fellow at Financial Executives International, working with their Committee on Corporate Reporting. So I was sitting in a room for 2 years with chief accounting officers of most of the Fortune 100, working on their agenda. And one of our projects was disclosure effectiveness. And I can remember discussions we had around their views, and I'm a CPA by background as well. So when I came back to EY post-fellowship and they assigned me to the Epic project, I was thrilled. not really. I was thinking, are you sure you've got the right person? But what's really interesting is you start to get folks that come with my background into this space, and you start to realize how important it is. I can remember sitting in a room with Lady Lynn Rothschild, and I'll come back to this, but Epic was a joint collaboration started by EY and the Coalition for Inclusive Capitalism. Lady Lynn Rothschild, who some of you may know, started the coalition, and she came to our first meeting and kind of described the problem statement. Coming out of the financial crisis and realizing something needed to be done to create a more inclusive capital environment, and what can we do? And EY jumped in and said, well, we've got this framework we've been building, and let's use that and test it. And hearing the story and hearing the approach that was taken started to get me there. And I thought, oh, this might be important. And then actually, and I'm gonna cue a video here in a second, but then they also shared with me the video that EY had been working on. And that really hit home for me, because I started to connect it to what I had been doing in the sort of financial reporting world to this world of non-financial value, long-term value. So I'm going to actually start with a video. Some of you may have seen this, and then my goal is to just share a little bit about what we did in the Epic space, particularly around human capital development, how we got to where we are today. Hopefully it'll be a nice tee up for Ant, who's done some really good research in this space. So if we could cue the video, please, and then hopefully this works.
If we want to understand how a company's value will grow over the long term, what metrics do we look at? Financial statements are still our most widely used tools, but might not reflect all the intangible assets that form an increasingly important part of a company's value. The things that drive this value are rapidly changing. With the advent of the knowledge economy, factors such as intellectual property, brand awareness, or investment in talent increasingly define value. But traditional financial reporting metrics weren't designed to measure them. And this lack of understanding is fueling an investment disconnect. Companies have good strategies for long-term investment, but if they don't have the metrics to demonstrate them, the investment community ends up focusing only on the short-term metrics they can see. Data is increasingly available, and more of it appears every day. So investors are making their own judgments by mining publicly available sources, and organizations risk losing control of their equity story. There's rapidly declining trust in business. Since the financial crisis, the trust gap between business and the rest of society has widened. So business has to re-establish its societal contract. Traditional financial reporting is no longer enough to explain a company's long-term value plan. But for new metrics to be trusted, investors need to have confidence that companies aren't cherry-picking what they disclose. EY has developed a long-term value framework to help identify the right metrics to reflect long-term value creation. The framework starts with an understanding of the context to which the organisation is responding, as well as its purpose, strategy, and the governance that underpins it. These factors will help determine which stakeholders are core to the organisation's value creation model and the outcomes it's aiming to deliver for them. This defines the outcome metrics, which will help communicate how successful an organisation has been in delivering for its stakeholders. Find out more about how EY is using the framework to help drive sustainable business growth and build a better working world.
Okay, so I think that tees up nicely the long-term value framework that we worked with at EY and during our EPIC project. If you I really like this slide because it kind of depicts the journey, and I think you mentioned this timeline kind of matches up, Cambria, to your journey as well. But if you go back to 2015, how did we get to where we are today with EPIC? Really started with Research EY Commission with Cambridge University, really looking into what are the new measures of value, what does financial reporting look like in the future. That led to sort of academic roundtables, investor roundtables, business leader insights. And then EY developed a white paper point of view around long-term value. Fast forward a bit to some additional CEO meetings that happened. Our CEO got together with Lady Anne Rothschild, coming out of the financial crisis. What are we going to do? Problem statement. Let's do this journey together. We happen to have this long-term value framework. Why don't we offer it up, open source it, and use it as a testing ground to help see what we can do in this space. So that was really what kicked off the project, the embankment project. I think that the name was something to do with where they were sitting across the embankment river or something like that. I will say, we didn't know it was going to be EPIC at the end, and we were trying to figure out the name of and it was perfect. So the group, so they gathered up what was really, and I'll come back to this, but what was really important about this project was if we were going to do this, we wanted to make sure that it included investors across the stakeholders across the investment spectrum, all the way from asset creators to asset managers, asset owners, et cetera. So that's really, and the work is ongoing. I guess that's the point here is there's going to be some additional phases, et cetera. For those of you, I don't know how many are familiar with the EPIC report, but we did produce a report that the EPIC sort of metrics launched in November of last year. There was some press around it, et cetera, but that is available. And again, the work is ongoing. So. Again, the basis for the work that we did was starting with this long-term value framework. Without going into too much detail, what I will say is that this was the framework that allowed us to create the environment to have discussions with asset creators, managers, and owners around how do we hone in on what are the appropriate metrics that we're going to identify in a variety of different spaces. We started off, all of the embankment members started off by doing a diagnostic that helped them identify really what I would say are the edges of this framework, the strategy, the context, the purpose. And I think that diagnostic piece of this process was really important. It got the sort of juices flowing. It helped us connect what we were trying to do with the organization that we were working with. So it was a really important process. Again, there's a lot to this model, but all of it is designed to ultimately get to what drives your metrics framework, et cetera. I'm just going to jump through these. Okay, so who was involved in EPIC? This was really important. 31 companies across the investment chain, 9 what we would call asset creators, 11 asset owners, 11 asset managers, representing 30 trillion in assets under management. I think this, this was, if you look at some of the other initiatives out there, this is perhaps what may be different than some of the other approaches that have been taken, which we felt was really important, and especially from an EY perspective, was a must-have. So going in, what was our hypothesis? Well, one, outcome metrics are insightful indicators of long-term value. Information is available, more available than it's ever been before. We understand disclosure is an issue. 3 levels of metrics, common metrics, company-specific metrics, sector metrics. And then data and analytics is a key enabler. I know you'll like that part, right, Ant? So we'll kind of get to this, but again, the steps for us on a very high level, this isn't rocket science, diagnostic, apply the long-term value framework, and then develop outcome metrics. So after we met, I think, for a few different working group meetings. After we sort of finished the diagnostic piece, we determined it necessary to set up working groups around 7 metric-based working groups. These are the 7 here. You'll see at the top, human capital management. That's the group that I was involved in. But we also had the 6 others, which also came up with their metrics, and their process was very similar to ours. This was another really key piece to our process. Not only did we feel like we needed the 7 different working groups, we also needed to have a backdrop of a methodology working group that would oversee the process we were going through, that would help us define what are the principles around good metrics. All of the metrics we came up with had to run through these filters. This team was there to sort of help support us and drive us in the right direction. Think of it in terms of a filtering process. If you think this metric is good, let's make sure. It was also really important to us, knowing that we were riding the coattails of many other initiatives out there. It was very important for us to make sure within the working groups, but also as a separate working group, that we were looking to other initiatives out there. And incorporating that into our process and respecting what work had already been done. It's a little bit small on the slide here, but those are some of the other working groups that were, other initiatives that were mentioned there. Okay, so within the working groups, and again, I think this was the same process that happened through all the working groups. What was our process? Well, it started with extensive sort of lay of the land research, finding out what was out there, review of academic literature, review of initiatives, existing metrics, et cetera. We then used that to hone our list down, a long list to short list, really. Very simple process, but not very easy to do. We had a few different approaches to do that. Ant may talk about some of this as well, but how many metrics did we start with in human capital? It was like 500 or something. Yeah, it was, so we really did take account for what was out there. Validation of our short lists. Okay, so this is something that came up during our process, was not part of the initial initiative set, but came out of our process during our discussions with the investment community and during our working group. The idea around narrative reporting really started to emerge. If I can remember the way one of our asset managers put it, he said, look, the metrics alone are not going to be sufficient. That's all we come up with out of embankment. That's not going to be sufficient. And the visual I have in my mind is an organization needs to put up their strategy, needs to articulate its long-term goal, needs to put up the signposts, which perhaps are the metrics, but along the way they need to narrate that and provide updates for, and so really this idea of the narrative around those metrics is what's really needed and really important. And then recognizing gaps and next steps, that was part of our process as well. Okay, so let me just get to I'm going to tee this up for Ant a bit here, but the Human Capital Working Group, what did we do in our working group? I will say this working group started out not as human capital. It started out as employee engagement. And it was soon into the process, and maybe Ant already knew this was where it would head, but I certainly didn't. We realized that the employee engagement wasn't all that meaningful to investors. We were hearing that theme over and over. What was meaningful is how you utilize your human capital, how you, utilization, retention, deployment of your human capital story. That's what was meaningful. Aside from turnover, that was sort of the only thing that really resonated with the investors that we had surveyed during our process. And sort of the need for consistent, comparable way to communicate. So we had some objectives going in. We wanted to make sure we were doing some statistical review, exploring narrative reporting, coming up with principles around good narrative reporting, and then developing a case study around that. So again, we used some academic research, which Ant will sort of talk about in a little more detail. So where did we get to? Ultimately, after our process, which involved a lot of research, a lot of interviews, discussion, we did determine that there were 5 categories of human capital that we wanted to focus on, which you can see up here. They're in our report as well. That was really the most important thing that came from our human capital work. And I think these line up fairly closely to what you came up with. What was our sort of conclusions after all of this, and where are we headed? This isn't rocket science again, but this is very, we felt like this was important. Employees are intangible assets of an organization with real value that doesn't exist on the balance sheet today, largely disclosed by firms. Utilization, retention, and deployment of those assets, like any asset that you would measure on your balance sheet, is really important. And disclosure is a key differentiator. And the ability for a company to accurately articulate its long-term value story around human capital is incredibly important, and perhaps the bridge that speaks to the investors of tomorrow. And finally, again, organizations should be evaluating, monitoring, and assessing their human capital. So that's where we are today. I didn't mention a lot of the good, really cool research we did in this space because I didn't want to steal some thunder from Ant, but maybe I can turn it over to you with the clicker, the green button. And you've got your presentation, but I know you're going to mention some of the research we did.
Okay, it's quite interesting for me because I wasn't aware that it's the first time I've heard your confession that you didn't think you were either into human capital or into pretty much anything in this kind of space.
I didn't know I was going to confess until
we had to use a big brown stick to keep him out of the office most of the days because he couldn't get enough. I mean, he really. So you were well and truly converted. I think it's quite interesting just listening to the discussion, and I sat in this morning's sessions as well, which were really interesting, and listening to Sally talking about her obsession with regression analyses. I kind of share that same passion, but the challenge that I was given by Epic was that I had to turn this intangible value thing into something that was going to be analytically robust. And of course, Einstein said that, we call things intangible for a reason. We can't count them. So already we had quite what I would say was a vigorous challenge. And we also have the problem with human capital, is that, I often talk to CFOs, particularly associated with Epic, but also elsewhere, that they'll often say, look, I really need HR to talk to me, not in PowerPoint, but in Excel. And the problem is, with HR people, there are only 3 types of HR people. There are those that can count and those that can't. I'll just let that settle. Yeah, okay, right. So I'm not sure where the asset management industry is on the basis of that joke, but we'll see how we go. Anyway, right. So without further ado, let's. I'm going to tell you the kind of story quite quickly in a way because A, I've told it a lot of times, and B, actually, I'd like us to get into the discussion because one of the the main reasons why I've, journeyed over the pond really was that you represent an absolute, population of people that I really want to engage with much more closely in this space. And that was the gift really that EY gave me. I kind of done a similar research for the UK government several years before. And my boss for a year was Vince Cable, together with Mark Carney. So it was funded by both the Treasury and the Bank of England. And that all came about, you might remember the story with HP, and they bought a company in the UK called Autonomy. And then they wrote down a tremendous amount of value several years later. And that was when the Secretary of State banged his hand on the desk, because actually writing off that kind of value meant that Her Majesty's Revenues, Customs and Excise actually took a hit as well, as far as value is concerned. So it was kind of, who's going to rid me of this troublesome intangible value was kind of, and that's where the Hesketh kind of guy turned up, not quite a drunken knight, but, and certainly not being knighted on the back of it, but I did that for the UK government. And that's how my sort of star rose with EY. And they kicked out Cambridge and put in Lancaster, which I think was probably the smartest move they ever made. Anyway, so if I could have my slides up, please. Well, you invited an academic, so it was always going to happen. But here we are. So this is the problem. This is what I lie in bed thinking about at night. As you can see, I don't get out a lot. And part of the problem is that the debate on both sides of that equation is fascinating to most of you in this room. A lot of you will spend a lot of time thinking about the relationships along this equation. But ultimately, that dependent variable over there, that's why I found it fascinating what Sally said this morning, and then listening to the session with Laurie and Celia as well, is basically the problem is what I call the modality of value. So the way that we value now is changing. We know that the relationship between society and organized capitalism is somewhat strained. And at the same time, society wants to understand what capitalism is up to in its name and with its money, quite frankly. And capitalism and organized capitalism and institutional investment actually is kind of doing quite a lousy job in being very transparent in that space. And if I could be really contentious to warm it up, for the debate later, I would probably say that, America is pretty opaque in the reporting space in this area. And so I've taken that on as a kind of personal challenge. But nevertheless, the whole idea about, sort of what constitutes performance, what constitutes robust data is a really interesting issue in terms of what we were trying to get at. And so what we did in EPIC, we went from 500 variables down to 50, we got it down to 10, we got it down to 5, we got it down to 1, that the team absolutely thought was the one variable that we wanted, and then we built up to what were 8 or 9, principally because we wanted to be able to calculate what I wanted to call the human capital asset, because obviously I had one eye on my Nobel Prize at the same time, although I think it's more likely to be Lynn Rothschild or Paul Pullman, whoever picks that one up. But we've got the problem on the other side, which is what's going on with human capital itself. So, fascinating this morning to look at this, sort of the issue around meritocracy and around bias and around how we measure these things. And this whole notion around the modality of value for me was how do we get hold of this analytically? I'm absolutely preaching to the converted in the room here, is how do analysts do their analysis? With what do we do our analysis with in the human capital space? And how can that analysis, and also how can the disclosure of the data that we create and the value points actually enable us then to talk a much better game to society about, one, the long-term value that firms are creating, and two, probably more importantly, what role or what does the relationship look like with wider stakeholders for firms? So we're not just talking about current employees, potential employees, former employees who might want to come back because actually it was quite a nice place to work. But we're also talking about customers. We're talking about business partners, collaborators, all sorts of different things. So it's not just about how you do business and how you do business with your people, but it's also about who you do business with and how they do their business with their people and whether they're the kind of people that you people want to do business with. So these are really big issues that are starting to shift value in very material ways. So these were the kind of indicators that we decided to get into on the right-hand side, and Erik's already talked a little bit about all of those. Just so you know, the number one indicator that everybody really went for was actually turnover. It was a quantum data point, and secondly, it really gave you an idea of what was going on inside a firm. If I was choosing any of all these indicators on this list, and certainly the one that, maybe the SEC might rule to make actually an obligation, i.e. compulsory to report rather than discretionary, I would say it's the total costs of the workforce to include their salaries, benefits, and so on. Why? Because that is the golden denominator. That actually is the goose analytically that will lay all of our analytical golden eggs, because what use or how fair can fair value be if we don't even know what the total spend is? And we have that problem with US data right now. And that was one of the big issues around long-term value, that we actually wanted to fix that opacity as far as organizations were concerned. And quite interestingly enough, those variables, thanks to Cambria and her team and Epic and others, there's a whole host of different people and different initiatives working in this space. And we're now getting to a point where I'm starting to read equity analysts' reports quite frequently now that are actually starting to use human capital indicators in their fair value analysis. So it's clearly part of the story now, which I find fascinating. So what we did was, if you want the sort of long version of this, we can talk about it over a drink outside. But ultimately what we decided to do was we came up with a human capital reporting index. So in essence, it was how deep and how wide do organizations report in the human capital indicators. So the kinds of indicators we were looking at were workforce costs, turnover, training and development, what we called workforce composition, in which diversity and inclusion and equality issues were all contained inside that. We had an incredibly broad and inclusive church as far as analysis was concerned. And again, I can get into the technicalities of that at a later date. But ultimately, what we did was that we then looked at all of the investor relations publications by firms, so we could actually see what they had to say and what they signed off themselves. And two very quick things on that. The first one, which I think is quite interesting, is that a lot of firms report a lot of data, but they report a lot of data in a lot of places, which makes your job very difficult in just terms of time. The opportunity cost of actually putting that stuff together, where it could actually be drawn together, seemed ludicrous to us. But the story was quite fascinating. So in the UK, on this index, we compared the quartile performance. So those firms in the top quartile who reported more widely and more deeply than other firms in that top quartile there. Somebody mentioned the data this morning. For every pound or dollar, it works, by the way, in either currency, just for the mathematical point. But anyway, so it's not a translation issue. It might be between maths and HR, but that's not the story. Anyway, but the point here is that for every pound that you invest in your people, you're getting a 300% return. Whereas that's a significant difference with those firms that seem to understand or themselves less or a little bit more opaque. Now, I find that data fascinating. That's just 1 year there. It repeats every year, and that linear pattern gets tighter every year as the market in this space matures. So I think that's fascinating. I'll come on to what that might mean later. This is one of my favorite slides here. So in the dark bars, they're the firms in the US that actually report their full workforce costs. It's a tiny percentage, 13% of firms in the US, S&P 500 report their workforce costs. But when you look at those firms, you can see that actually they outperform operationally, whether you want to call it EBIT, EBITDA, net profit margin, and of course the retention ratio there, which of course then is the perfect opposite when you look at the payout ratio. And those firms that aren't disclosing in that their human capital and other indicators seem to have a slightly more shareholder focus on them as opposed to a long-term one. Again, I could get into the details behind that data, and I haven't time to do that right now. But that's fascinating. And of course, you get the challenges from the asset management industry. Well, that's all very well. That's your index, Ant. What about our indexes? What about our data points? What about the way we do our analysis? Well, hey, guess what? If you actually want to look at this in terms of means excess returns, the company standard. Okay, I'd like to see less volatility in there, although I know some of you like a bit of volatility thrown in for good measure. But nevertheless, this data is quite interesting. So from my point of view, at the very least, if I was being really, really conservative and I was being a reviewer for, a blind piece of academic reviewing on an academic journal that was put in front of me, I would certainly say that I'm looking at data that enables me to reject the null hypothesis. Human capital is material, ladies and gentlemen. It actually matters. And if the job of directors of a firm is to report on anything material, as far as the performance of the business is concerned, in the UK in 2013, we passed a law that basically said that all firms had to formally state what their level of materiality was for their financial statements. That's normally around about 1.5% to 5% of revenues. When we take that formal material figure and actually then put that and compare that against the spend on human capital by those organizations, you can see from this data point, which summarizes the whole FTSE 100, that actually you've got half of the FTSE 100 exceeding the level of materiality. The spend on their human capital is by a factor of 20. And in the UK, we're quite good at reporting because we have a lot more regulatory space. We operate under European IFRS, so we have to report our workforce costs. And there's a whole host of other things as a result of that. If you look at the US, however, what we find in the US is that, we have this wonderful median proxy statement form where you give us that data point, which is useless from an analytical point of view, and it creates all sorts of other kinds of issues. But at the very least, my challenge to you will be to say that actually US firms are breaking their fiduciary responsibility insofar as they are actually not reporting on a whole host of these spaces. Now, the US is starting to improve and improve quite dramatically. So for me, there's kind of three very, very quick points I would want to make. The first one is don't get hung up on the leading indicator debate. You remember we had this discussion ad nauseum in Epic, where I was basically saying, and again, I'm not preaching to the converted here. I'm absolutely challenging the choir at the moment, which is most of this industry, most of you in this room aren't going to shift anything until you feel like you have a leading indicator in place that makes you feel like you've got a robust case. What the challenge now is, in my view, as far as Epic is concerned, is actually you've got to decide what the indicators are that society and industry wants to lead by. What do you want to report on? Actually, and that will then create a different kind of marketplace. The second one is around veracity. The first one is around leading the leading indicator. The second piece is around veracity. The problem is that excuse the pun, but we are in the state of the Wild West as far as human capital indicators are concerned. Anything goes. So what we've tried to do in Epic, and I would really, sort of encourage you to go and read it, and the ISO standards that have come out on the back of that as well are very worthwhile and useful in terms of a common standard that is now starting to be used, is that we need that veracity. And once we've got that veracity in place, we can then build models that actually are going to be much more robust and give us an insight. And if the research that we've conducted so far in ROIT is anything to go by, I think those models are going to start revealing different types of leading indicators to us, which is very exciting. And that brings me to the last point, which brings me right back to where Cambria is probably going to lead off from, which is around governance. So at this point in time, whether the SEC decide to rule, I doubt very much whether the House of Congress is going to make much progress, given that it's got to then go up to Senate, which might get a bit of a roasting, I would imagine, given the predisposition of Republicans not towards any kind of regulation in this space. I think we have all kinds of issues. But ultimately, we have to start reporting. We have to put our house in order. The opacity must stop. Because, if I could leave you with one final point, if you think about my graduates when they're leaving Lancaster, you need straight A's to get to Lancaster. It's quite a strong institution. I'm not going to do too many adverts for us, but, check us out all the same. Send your kids to us. We're much cheaper than you would be in one of the schools in the US. That's a very good, efficient way of going forwards. But actually, when they're graduating with their great degree and they're deciding which company they're going to go and work for, it might be a 50-year deal. They're going to work to they're 70 now. They're probably unlikely to work for one company, but potentially they might do so. On what basis do they make the decision about what is the level of evidence about which firm I go and work for? Is it the quality of biscuits at the assessment centre? Is it because my dad or my mum worked for them, or my brother had a good time, or whatever it might necessarily be? We need to be much more transparent about what's going on. So on the one hand, there's a performance case, and on the other hand, there's a much bigger social capital element in that space as well. And on that, Cambria, I'll hand it back to you.
Thank you. This is all very fascinating. I just want to do a quick time check on how much time do we have.
Oh, they're resetting the
Oh.
clock. There we go.
All right, perfect. So the first question I wanted to ask you guys, with Epic, what has been the feedback that you've gotten for your work from the marketplace, from other stakeholders? What's the reception been?
Yeah, so do you want me to start? I mean, everything I've heard to date has been really positive. We got a lot of good press in November when Epic launched. I think the proof of that is really what's been going on since then. And there's been a lot of discussions with a lot of interested organizations in what's going on with phase two. If you look at the approach that was taken, it really only included, despite it being 30 trillion in assets under management, it really only included 9 asset creators, was it? And in a few different sectors. And we've started to see interest from other organizations saying, well, geez, it's no secret, J&J was involved. They were the ones that led the human capital working group. Others in their sector are now saying, geez, why weren't we included? And maybe we need to get involved. And so I think that reception has been positive. I think, I don't know, Ant, what you've been involved in discussions with Lady Lynn as well, post Epic, and probably have even more recent insight there.
Well, I think long-term value generically has captured people's imaginations. I think people want that stretch over time, that security in some ways. From a human capital point of view, I think it's been really fascinating insofar as I've always been this advocate that, Pacchioli got it wrong half a millennium ago. Pop them on the income statement as a cost, because of course employees were 10 a penny. You actually went out and clubbed people over the head and put them on a ship, and sailed them somewhere, as far as the artisans were concerned. And that was basically an employee. And it didn't get much better a couple of hundred years later, when Adam Smith and others were writing, whether it was in pin factories or in agricultural economics. Again, employees were, people that you could basically, they would dig a furrow, they would build a hay bale or whatever. Again, things are slightly different now. So I don't think it's right to look at human capital as the gasoline that you run through the engine that you source as cheaply as possible. I think it's the engine itself. And actually you need to, if we start looking at human capital as an engine, I think that's the big difference I've seen post-Epic, is that I think if someone had said to me that the SEC would have been contemplating having a roundtable, starting the discussion around what variables need to be reported, whether they need to be compulsory or not. If you said to me that would happen within 5 years of Epic, I would have said probably not. If you said to me that it was happening within 5 months of the publication of Epic, I would have laughed at you, and yet here we are. So there's clearly something going on as far as that's concerned. And I think progress on the Hill is probably, or at least it making the discussion on the Hill, is also a reflection of the zeitgeist that Epic captured. I think the human capital space probably captured more of that because we had quite a robust set of analytics around that space. And we focused on that space principally because we knew it was woolly and we wanted to sort that out. And I think it's really important, and it's also worth mentioning, that the big impact now is that whereas previously there's been, I think one SEC committee member who will remain nameless during the debate came out with this wonderful phrase saying, I do not want the camel's nose to get inside the tent. I don't want this kind of invasion inside organizations around the competitive advantage or whatever it might necessarily be. And yet actually the zeitgeist is very much against that. And you can think of, the firms, you only have to go down the list of the firms that were involved in Epic. $30 trillion under management, sort of the largest investment asset managers in the world involved. And they are basically turning around and saying, which is what the SEC recognized, that we want you now to rule in this space. We actually want this data. We think this data is pertinent and actually material to our financial considerations. So it's high time now that we define this data so we can compare onions with onions. And that's kind of where we're at.
Yeah, I'll just add two things. One, I think it was very easy for many of the investors that we were working with to get very excited about some of the research we were doing, which you presented, the ROIT information. And I think there's a general sense, Cambria, that they want to see more in that space. Like we've shown disclosure, correlation with performance. We want to see causation, and how do we get to that? So I think there's that piece. The other piece that's happened is I'm in the consulting business, and this has been a great platform to have discussion. I haven't met a CFO, CEO, executive at an organization that hasn't found this fascinating. They want to talk about this, which I don't know that I could have predicted that before. This wouldn't have been a topic I would have taken into a CFO before, but it's been a great platform for us to engage in discussions. They're all interested in this, and they find the work that we've done fascinating around this space. So those are two additional.
No, I would totally. And for the HCMC's experience, we're doing a project right now where we reached out to about 30 large corporations in the US and asked them a set of questions. What's your human capital management strategy? How does that tie in with your business strategy? What metrics are you collecting? What are you doing with that information? How do you use it as feedback to inform your business? And those conversations are getting much better. And I think over that period of time, even in the boardrooms are talking about this a lot more, which is really important. Some companies even have human capital management committees. And also you have the role of the chief HR officer, which, this is a shift from sort of the risk management, make sure we don't get sued today, to a strategic partner in, within the management team and in the boardroom. So there has been, quite a bit happening very quickly. And that's why these conversations are so important. Because, I think there still is a bit of uncertainty around this, but we can't address that if we're not engaging in this dialogue. So we do have we have about 7.5 minutes. Maybe we can cover compulsory versus voluntary period of time. Probably not, but let's start the conversation, because this is really a key question that's happening. I mean, I think you've heard from Erik and from Ant and many probably other places, we're all recognizing the importance of human capital. I don't think that's really a debate. But the question is, again, how to get there. So from the Human Capital Coalition, HCMC perspective, we've always acknowledged that there are going to be metrics that are universal to companies. These are just descriptive ones. Turnover, I think, is a perfect example, cost of the workforce. But also metrics vary, from one industry to another. We found that from the very beginning, even when we started talking to retail companies, even from one company to another, depending on what their strategy is. But I know that we don't all, necessarily agree on that piece. So I'm going to start with Erik, and I'll turn it over to Ant and jump in.
Sure, and I know we're a bit short of time. I'll just share. This is an area where I'm really concerned, I would say. Partly because I lived through the disclosure effectiveness in the sort of chief accounting officer space, et cetera, and saw, what some of the things that happened with some of the SASB initiatives, et cetera. So a couple thoughts here. I think the best thing to do with EPIC right now, or human capital metrics right now, is to let this breathe. And I'm a little worried about it going down the compulsory space. The kind of discussions I'm describing we're having with CFOs and others that are owners of the sort of financial reporting that gets done today, the 10K, the Section 16 officers that are signing off on that. they would shut down a conversation pretty quickly if I were to go in and say, and we're looking to make you, to require you to disclose this information. The simple reality is we're finding that many of them aren't even like disclosing it within their organization all that well. And there's not, let's start there. And I believe that there's a much better way to pull this information from the top down, from boards, and we've talked about this, than going down this sort of compulsory rulemaking route, which I think it has its consequences. You have to think about it. I mean, look what happens when you have new disclosures in the financial reporting world. What happens? They become template, sort of very scripted. It's not a lot of information. The goal at that point is to check the box. It's not to provide good detailed information. And we have so much momentum here right now. It was all built on a foundation of open, we don't know where we're going, transparent. Let's all volunteer to be in this ecosystem together and build something good. I worry about killing that a bit. So that's my biggest concern. I guess the other piece to this, and I'll say this quickly, is you have to think about how this would get implemented within an organization. The reality is the Section 16 officers today are not the same people that produce this type of information today. Much of this information is coming from other parts of the organization to which those Section 16 officers are not, there's not even a dotted line perhaps in terms of reporting. So you would have to address organizationally, there would be some challenges there. So given timing, I'll kind of stop there. But obviously I'm all for the human capital disclosures, but the approach we're taking and the next steps and compulsory, I'm not for that.
Let me ask a question before I turn to Anne, because I know Anne has strong reasons on this as well. What about, so one of the things that we've kind of been talking about is turnover, right? I mean, we're all pretty much in agreement. That's a ratio, right?
Yep.
It's not, it's something that could be cleanly, I think, defined from a reporting perspective versus something like human rights commitments. That's something that's more of a narrative, maybe. How do you feel about that? I mean, is there a way to bifurcate the approach?
So let me share a quick story. So one of the things we did with all of the working group members was we did our own assessment. Each working group member did their own assessment of what metrics they're reporting of the 5 that we came up with, 8, depending on how you count. J&J, as you know, led this. If you look at their Health for Humanities report that was just released, we just got a note from their investor relations group. They included turnover now which they hadn't been including that information before. So my, I guess, answer to that is this process is working. Keep going, keep pushing the pull versus the push. And I think you'll get more and you'll get more transparent information. So I agree, it's easier. That one's easier to sort of get more consistency and it's very targeted. But then you get into questions around, all right, well, turnover matters in the context of the employee base. So then is it with key employees? Is it turnover with key employees? Is it with certain geographies? And are you going to sort of make that compulsory? So I think there's some challenges. Again, you want to drive, let's get some momentum going with this. And then once you start having more information out there, it's going to be easier to then make the consistency element there.
So let's pop over to Anne. I want that.
On the current level of momentum, Eric, we're sort of T minus 500 years maybe. Another Pacchioli might come around at that particular time. So I totally disagree. I mean, I actually think it's time to get capitalism's house in order, and I think that was very much the Inclusive Capitalism Coalition's idea, which is just fix the relationship between society and business. And one of the quickest ways of doing that is to be transparent. So the UK experience was really interesting. So with Sir Vince, very adept politician and quite a clever chap. He used to be the chief economist for Shell, so he's no slouch. And I remember Vince saying, well, why don't we just put this out to society, take the Erik approach, which the Erik Bradbury approach is always, going to be the one that most consultants advocate. Don't upset the clients. And also we thought that society would actually, basically hold the firms to account so it would happen. And guess what? It didn't. So we legislated for gender. and the gender pay divide. And now we're legislating for ethnicity and diversity, which is coming on stream this year. And you know what? Nobody died. And nobody went bankrupt, certainly not on the basis of their human capital indicators. Nobody lost any competitive advantage. But you know what? We've got a lot more data. We can start answering a lot more questions. So the kinds of issues that we heard about this morning earlier on don't come as surprises to us anymore. And not only do they not come as surprises to us in aggregate form, but we can actually look at them in individual organizations and make our own decisions about whether they're getting their houses in order. Because really, it just enables you to quickly do, sort of a quick set of questions, what I call the 4+5. What's the strategy of the business? What's the role of people? How are they doing? How do you know? And then you've got the 5 analytical questions, sort of what direction of travel is the performance of your people, moving in, where is most value located and being produced inside your business? Where would I invest? How do you compare against your competitors? And ultimately, it's just looking after your people. How good are we doing at that particular job? And if you're doing well with that, guess what? I imagine that the firm would perform quite well. And just very quickly, the conclusion that we reached with Epic, so this is a bunch of CEOs, CFOs, chief operating officers. Erik was even there too, and I think you kind of agreed with us as well. We're the kind of Laura Notti of Epic. I think we're going to have to sell ourselves at some stage. Anyway, and what the kind of conclusion we reached was that these firms that seemed to be reporting more about what was going on within their own organizations, not just in the human capital space, but elsewhere, they had what I call quantum clarity. They were managing their businesses well enough, and they felt confident enough in that management to start putting out data points to be able to say, this is the direction of travel in which we are moving. And that seemed to make intuitive sense to us all at Epic, that actually, well-run firms are quite confident about putting their data out there, good, bad, or ugly. One of my favorite firms who I would absolutely encourage you to go and have a look at in the human capital space, Novartis. Just, quick look at their annual report, pages 25 to 27, bang, you're away. That's the exemplar. That's what we're aiming for. Yeah. So we know what good looks like. We just need to make everybody do it, and then it'll be a lot easier.
That's a perfect point to stop on, and also got homework for the audience. So I want to thank our Erik and Ant for joining us today, and really hope this was helpful for everyone. Thank you.